Hi, what I'd like to do now is to demonstrate hedge accounting, and for this purpose I'm going to use a foreign currency import transaction, and we're going to have a hedge of that transaction. So in this particular case we have a hedged item, and the hedged item is an agreement to purchase air conditioners with a value of $100,000 from Cool Air Manufacturing, and the order is placed on the 1st of March. The air conditioners are shipped on the 31st of March and title passes, and the exchange rates on these dates are 75 cents and 72 cents. The transaction is not settled until the 31st of July, and the financial year end is the 30th of June. We also have a hedging item here, and the hedging item is a forward exchange contract. It's entered into on the 1st of March, and it's for a delivery of $100,000 US, and the exchange rates for delivery on the 31st of July are as follows: 31st of March 72, 71, 69.50 and 67 cents on the 31st of July. By definition, the forward rate on the 31st of July is the equivalent of the spot rate. Just so that we can get the maths out of the way easily, what we can see here is the $100,000 converted at the different exchange rates. 75 cents, it's 133,333. At 72 cents, it's 138,889, and the difference is $5,556. And you can see we do the same for the 70 cents and 67 cent exchange rates, and we have the same done for the forward exchange rates. I've got this out of the way so you can see where all the numbers are calculated, Let's think about the recording of the transaction. Well, first we need to appreciate that there are critical dates, and we have two transactions, and it's probably going to make things more understandable if we keep the accounting for these transactions separate. On the 31st of March we recognise the purchase of the inventory, and on the 30th of June we have to recognise the fact that the foreign currency payable has gone up in amount. It's now not an amount of $138,000, it's now up to about $142,000, and so we need to recognise a loss in the statement of profit and loss, and that would be done in accordance with accounting for foreign currency transactions. Similarly, we'd have to recognise another loss immediately before settlement, and we'd recognise the payment of the foreign currency payable on the 31st of July. So what you can see is that we ended up paying $149,000 for our inventory, which we thought we were going to pay a lot less for. There were losses of about $10,000, and these losses were actually real economic losses, and it was for that reason that the hedge transaction was entered into. The hedging transaction is actually entered into on the 1st of March, and that makes it a hedge of a firm commitment. We could also say that it's a cash flow hedge at this date. It has the same effect. And just to make it obvious what's going on, I'm going to recognise it as a derivative, and at inception it has a cash payment of 0 and it has an asset value of 0, or a liability of 0. It makes no difference. On the 31st of March, the contract has a value of $2,914. And the challenge with recognising that amount there is, what do we do with the gain? We have problems matching it with the gain on the physical transaction, because we can just recognise the physical transaction, so there's no gain there. So rather than treat it as a gain in the income statement, what we do is we take it through to inventory, and that forms part of the costs of acquiring the inventory. The forward exchange contract changed in value again on the 30th of June, so we make an adjustment to the asset, and we recognise a gain this time in the statement of profit or loss, and on the 31st of July we recognise a further gain, and we have a settlement of the contract. Now, what we can see here is we get a sort of balancing of the gains and losses on the hedge and the hedging item. And you might say these items don't balance out perfectly, and the reason for this is actually differences in the interest rate component. And you can see that the differences between the physical gain and the hedge gain equal 4,598, and these are the same as the differences in the spot rate. And what that's telling you is that what we've actually got here is there's two components to the hedging gain, and that is there's an interest rate component and a hedge component, and yes, you could separate the two if you felt so inclined.